Hello, I'm Mike Graham, the president of Midwestern Securities and your host of Banking on Growth podcast. Thank you for being with us today. With us, we have our friend Angela Beblo with Jackson Kelly. Welcome, Angela. Thank you for being with us.
Hi, Mike. How are you doing today?
I'm good. How are you?
I'm good. It's a little cold here, but it's better than having 8 feet of snow like Erie does.
Yeah, it's a little cold here too, but glad to have you with you. Glad to have your perspective on our discussion today. Will you tell our audience a little bit about yourself and your firm before we get started?
Absolutely. So I'm a member with Jackson Kelly. We are headquartered in West Virginia, but we have offices in several other states, including in the Midwest, in Indiana and Kentucky. It's a full service firm. We've got about 150 lawyers and do a lot of kind of banking and finance and transactional work. We have a member in Indiana that actually co-founded a community bank, American Community Bancorp, that's now actually the German American Bancorp. And, a bunch of our offices, we've got some in-house counsel from banks that are at the firm. We've got some people that have been doing banking law for a really long time, and have a great knowledge of community banking and the system and financial institutions generally.
Yeah, sounds like it. Sounds like you plug in the same space with the same commitment to community banking that we do at Midwestern Securities.
Absolutely.
Yeah. So today's discussion, we want to take a dive into numbers. Really, why performance numbers matter for community banks. So I'm looking forward to hearing your perspective and your thoughts on some of these numbers that banks should be monitoring and hopefully are. Can you give us a little banking 101 and a general idea of some of these metrics in the numbers that bankers should know about their institution and their competition?
Absolutely. And I think the main point of, some of our conversation today is going to be kind of basics matter, right? You're starting out in banking, and pretty much every organization now has their banking 101 or their bankers school or their bankers conference, right? And you go and you learn not just the balance sheet and, assets and liabilities, but you learn about metrics, right? You learn about that return on assets. You learn about your capital ratio and your efficiency ratio and how many accounts are reopening versus newly accounts and withdrawal rates. And, you kind of learn it, and then you get into your career, and not that you forget it, but you don't maybe focus on it as much anymore, right? You put some of the stuff in your quarterly call report and you kind of keep going on. But I think it's really important as you dig into some of those metrics and some of those numbers that as you're looking at telling the bank story, right? Like, is it healthy? Where's its strengths? Where's its weaknesses? But it also gives you an opportunity to find out where are the places you could not only do better, but also maybe make some changes and make your bank stronger. And I think as we talk about probably later today, some failures, and the difference is really in how long it took banks to fail back in the 2000s versus how long it's taken banks to fail recently. Those metrics, I think, become even more important, because what used to take a year and a half or 2 years or 3 years now sometimes can take a matter of days. And so when you are looking at your numbers and when you are thinking about your numbers, you have to also think about how often do we want to monitor those numbers, right? Like, if you start to see something go out of whack a little bit, like, do you need to monitor it more often now? Do you need to monitor it in a different way? Is something that didn't used to be important now going to be really important with your metrics and things that you should be paying attention to?
Well, let's talk about some of these metrics. I'm a big believer in what gets measured gets done. And so there's lots of different ways to look at some of these, but what do you think are important, and how should a financial institution prioritize looking at these?
Well, I think, from a banking perspective, from an institution perspective, sometimes what you're going to be focusing on is also going to be dependent on your bank, right? So if you are looking at your numbers and you start realizing, wow, we're really heavy in real estate, right? Maybe we want to measure that. Maybe we want to see and make sure that if we're 14% or 15% or 25%, maybe we want to try to get that down to a different number. And there's different ways that you can do that, right? Like there are ways to restrict lending, there's ways to increase accounts and deposit accounts, but that may be different than somebody that does a lot of maybe online banking work. Maybe you're partnered with a fintech, and you're getting a huge depository increase because of that. So maybe what you're focusing on then and the numbers that you're managing is going to be more on that kind of deposit risk than it's going to be on your loan risk.
So I'm a shareholder in a couple of community banks, and I'm the president of a holding company board that owns a community bank. A lot of the bank presidents, community bank presidents in the markets that you guys work and we work also have lots of different responsibilities. Some of them are writing loans. Some of them are they're doing the call report. They're dealing directly with the examiners. Some of them are opening the banks, closing the banks. Signing paychecks. Right? They're involved in it all. How does a community bank stay on top of their numbers, and who do you typically see doing this? You've got to inside of the bank. Is this a board meeting? We're going through these numbers every month. Is this a president's responsibility, a CFO, COO? Can you shed a little bit of light on that?
Absolutely. And I think this is one of those areas where you can leverage technology, right? So there are a lot of reports now that, you can run with the push of a button, that before it used to maybe take somebody 2 weeks or 3 weeks to generate by hand. Now you can run them very easily with some software. But to your point, maybe it's the last priority on my list because I'm a teller or, I am the CFO and I'm wearing all of these different hats. But I think from the perspective of who runs the numbers is less important than seeing, are the numbers changing? And if the numbers are changing, like how much have they changed, right? If there's a 1% change in your deposit amount for a month or a month over a month change, that's less concerning. That's not a board issue necessarily, right? Now, if your deposits have decreased by 5% or 10% or 15%, in a 3-month period, if you're not paying attention to that, then you're potentially going to create problems, right? If you're not paying attention to the little variations on the front end, you're going to look back and be like, how did we miss a 10% change or a 5% change or a 15% change? And so I think, initially, like what we're talking about is just kind of paying more attention to those numbers as the little incremental changes are happening. But then being able to look at it and say, wow, in the last 12 months, we've seen this massive change. Or in the last 6 months, we've seen this change. And so then you start talking about where does that get elevated to, right? Like if I'm the CFO, and I'm responsible for this, or I'm the branch manager and I'm responsible for this, it's one thing to anecdotally stand around a conference and say, oh yeah, our newly deposited opened accounts are lower too. It's another thing to be able to look at that hard data internally and say, wow, we have lost this amount of accounts, or we have opened at a slower rate than we thought we have. And to a point that you actually made a few episodes ago, a lot of that is also going to change over time, right? 2 years ago, 3 years ago, 4 years ago, banks didn't care about liquidity. They were swimming, right? Like that liquidity was not a problem. But today you ask somebody and they're going to tell you, absolutely, liquidity is a problem now. And so a lot of what you're looking at is going to change over time. It's just making sure that you are looking at those things, those small changes, to make sure that those small changes don't become big problems.
So we leverage software like Bank Trends to track what's happening with our community bank partners to see how we can add non-interest income, improve their efficiency ratio, things of that nature. Do you see community banks typically leveraging an outside service like that, or are they looking just really with their mix of business and their ALCO committee or whoever that might be?
So I think, again, it depends on the bank.
Sure.
The smaller the bank, sometimes I see them rely more on kind of their vendors, like their core processor and some of those other vendors that they're using for systems. If you have some of the larger banks, then I do see that they're using other types of vendors and services and things like that, because for them, they have a little bit more room in their budget. Maybe they've got an actual IT person on staff because they're big enough to do that. They don't have to outsource that sort of thing.
Sure. Good point. Yeah. Thank you. So you mentioned the pace of change has just escalated. Let's talk about that a little bit more and how that might have affected some of the older big bank failures versus some of the more recent ones.
Absolutely. So I think for me, one of the biggest bank failures, and it's still the biggest bank failure, is Washington Mutual, right? And for those that have been in the banking industry for a while, WAMU was and still is the largest single bank failure in history. Now, we're not talking savings and loan, we're not talking some of the other stuff, but as far as banking goes, like Washington Mutual is the biggest bank failure in U.S. history still. And it happened back in 2007. So I can't imagine 2007, 2008 dollars. Well, I guess it technically happened in 2008 when they closed it, but I can't imagine those dollars now and what they would be like, 15 years later or almost 16 years later now. But one of the interesting things about Washington Mutual and kind of the lead up to Washington Mutual, when you look at bank failures as a whole, there have been 568 total bank failures between 2001 and 2024. In the entire period, they had 568. 2005, 0 bank failures. 2006, 0 bank failures. 2007, there were 3. And for those people that were in banking back in that time, you remember, housing was going up. You had all of these no doc loans. You had a ton of just like the economy was chugging along and chugging along and chugging along. And banking is great and finances are great. And all of a sudden the housing market crashed, right? Well, when you look at Washington Mutual, only 14% of its business was in home loans. 60% of it was retail banking. This was a multi-billion-dollar bank, right? 14% of it was in home loans. And what they had done and what caused them to fail was they had a lot of housing cost in California, which was very heavily hit by the real estate downturn 2007, 2008, right? And so they ended up having to write down a bunch of their portfolio. $1 billion+ in loss. And then knowing that they were going to get a hit with more because of the fact that they couldn't sell those securities anymore because a lot of those homes were now underwater. And so their securities weren't worth so much. But the interesting thing about it is when you look at it, it took months. Like it took 9 months from the time that the housing crisis started to when the FDIC took over in September. So, they closed the bank September of 2008, sold it to Chase, reopened it, as we all know from bank failures with the FDIC immediately kind of the next day, right? It is seamless from a customer perspective, right? And if anybody wants to read a really great book about the financial crisis, Sheila Bair, who was the head of the FDIC at the time, wrote a book called Bull by the Horns, and she gives you a whole bunch of inside baseball about what was going on during the crisis. And it's very interesting to look at the perspective of the FDIC as they are going into these meetings with all the bailouts, with all of these companies and these too big to fail banks and things like that. But when you look at, Washington Mutual, when you look at some of those failures from 2007, 2008, 2009, a lot of them, like Washington Mutual, are months in the making. Like you can see in the quarterly reports that they're taking losses. You can see in the quarterly reports that there's some over leverage or under leverage or things that are going on. And eventually the FDIC gets around to, closing the bank and selling the bank and auctioning everything off. And that is very different than some of those recent bank failures that are happening in days and not necessarily in months.
Okay. Before we go into the more recent bank failures, this is really interesting. Will you walk through those numbers again of at the beginning of this, you mentioned 568 bank failures?
Yes. 568 bank failures total from 2001 to 2024.
Okay. Interesting. And how many happened in 2007?
3 happened in 2007.
Wow. I would have thought more would have been in 7, but maybe it was just cascading. 7 was just the dam started to crack, and 08 and 09 it broke.
Yeah. Well, in 2008, you had 25, and in 2009, you had 140. So you're absolutely correct. Like, it kind of started back in 2007, and then it was just this ongoing kind of cascade of bank failures for about 2.5 years.
Interesting. So I'm guessing in 2001, there was 8,500 bank charters in the US. So,
Something about that. Yeah, I was going to say, I think we've gone from 8 to about 4, if I remember the last numbers I've heard correctly.
yeah. So just
Um,
trying to put it in perspective,
so, yeah.
568, slow from cracks in the dam to the dam busting, 9 months. Tell us about these more recent ones. These things stick with clients. I'm still client facing. Clients come in and they might say, should I buy a CD with quote, all these bank failures happening? Like all these bank failures, there were 3 in the last 24 months out of 4,000 and some change. It doesn't appear to be, all these in quotes, worthy of that, but the negative sticks with people and they're afraid of that.
Absolutely. And I think at the same time, one of the base fears is, what my mother told me during one of my first cases is that's my money, right? Like that's my money. Like, what do I do if I don't have my money? Like, how do you pay your bills? How do you pay your mortgage? Like, what do you do if that's your life savings? And I mean, that's part of the FDIC's promise, right? Is you put money into these secured products that, the FDIC is backing. I say secured, but like CDs and kind of things like that, like insured is probably the better term, I guess, or the proper term. But, you put your money into the bank on the faith that the banking system is then going to give it back to you, right? You put your money into investments in the stock market and you know that that's not guaranteed. But if I put my money in this CD at the bank and they promise me 5%, I want that 5% and I want to make sure that my bank's not going to fail. Right? That terror that people have is because that's my money, right? Like that's my lifeline right now.
Depositors who have more than the FDIC limit, the insurance limit, I don't think fully understand and appreciate the awareness that mom, pa need to understand FDIC limits. They're concerned, to contrast this and maybe take this a little bit in different directions, just briefly, Angela. They're concerned about money market mutual funds and money market mutual funds, quote, breaking the buck and going from $1 a share to 99 cents a share, which I'm guessing happened a lot less than 568 times the last 24 years.
I'm going to guess it probably happened closer to 0 than it did 568.
Exactly. So both are very, bank accounts and money markets, very safe, safe, accessible. But the FDIC insurance still has that perceived safety that is higher than the perceived safety and predictability of a money market mutual fund. But maybe the math of bank failures versus money market mutual funds breaking the buck might shed a little bit different light on that. Again, very marginal because both are so historically so safe and have been so predictable. But just as you're talking about those numbers, that just jumped into my mind. I wonder, money market mutual funds breaking the buck versus bank failures.
And I think part of that then comes down to, those client relationships, right? If that's something that you are afraid of, being able to walk in and talk to somebody from Midwestern or talk to somebody from the community bank that you're at, like, how safe is this, right?
Mm-hmm.
Like, you really have the ability to not only help somebody kind of not necessarily get over that fear, but work through that fear and realize that it's not necessarily a very large fear that they have to worry about for their accounts. It gives a great opportunity for an outreach, for that touch, to solidify that relationship because, when you're making them feel better about their money, they're going to trust you.
Mm-hmm.
Right?
Absolutely.
Like, and if you can reinstill that trust in them, then you can potentially market to them some of the other services that the bank is offering.
You bet. And that's customer leadership. It comes from having time to be client facing and having time to get to know the customer and educate the customer on how these things work and what their risks are in FDIC products and in mutual funds, securities, and help clients navigate these complex financial markets. Fortunate to be in the United States of America and have the best regulatory system, the most transparency of any financial system in the world that I'm aware of. But it's still complicated, and there's still a lot to factor in as a consumer. That's a great advantage for community banks to be able to be so close to the customer, as I've talked about on this podcast before. Let's come back to where we were going, though, before I derailed us a little bit. So things are escalating. These more recent bank failures. Can you speak to that?
Absolutely. And so we'll talk about, one from last year, Silicon Valley, and then one from this year. So the first one this year, which was Republic First Bank, that happened in April. And when you look at Republic First Bank, it happened in a matter of months, a handful of months. So, they were delisted from NASDAQ back in August of 2023. Mostly because they failed to follow all of those regulatory requirements that you were just talking about. They had failed to file some reports and some other stuff. And so they got delisted in August. And then they reported a negative $40 million income for 2023, net operating income. So, they got to the point at the end of the year that, that's a pretty big number, right? If your bank is going to be at negative 40 million, there's probably a report that you could have looked at during the year that would have given you some of that information way before it reached that 40 million number. And essentially what happened is, their liabilities and their assets were just about equal. And so the FDIC came in and said, you're done, right? And that was about less than a 6-month period that all of that's happening in, that we're seeing, as far as I'm sure internally, there were probably some red flags going off before all of that happened. But from the public facing perspective, it did happen in less than 6 months. So you've got a very fast transition on that one. Although it wasn't quite as fast as the Silicon Valley failure. Now, Silicon Valley is a little bit of it's a specialty bank. So it's a little bit of an anomaly, but it also has a lot of fintech aspects to it that may impact community banks, which is why, as when we kind of circle back on numbers and why it's important to know some of this stuff, may be helpful for banks. So, Silicon Valley really focused on venture capital. They had a lot of those large uninsured deposits that you're talking about, right? They did payroll for all of the big companies in Silicon Valley, in California, all of those startups, all of those venture capital funds that are just rolling into your fintech and, app companies and things like that. And, they'd had some problems, not anything that was super serious. When you look at the Fed reports, they'd had some disclosures and some averages, some weighted average that, looked a little off. But, what happened was they hadn't properly managed their risk. So they had all of these large uninsured deposits from this capital that was there. But they had a 10-year bond fund. And so when you looked at their balance sheet, as bonds decreased, the bank had a ton of increasing unrealized losses on their balance sheet because of those bond decreases. And, on March 8th of 2023, the bank had kind of realized it. And I think they probably realized it a little bit too late. But on March 8th, they were like, hey, we're going to offset some of these losses. We're going to borrow a little bit of money. We're going to sell some of these securities. On March 9th, you had a number of advisors to some of those companies in Silicon Valley that told them to withdraw funds from the bank, right? You have a ton of uninsured deposits with our money sitting in Silicon Valley. There are problems. They've just announced it. We need to start moving money. Okay. March 9th, the day that those advisors started asking them to move money, $42 billion were withdrawn. March 10th, the day they were placed in receivership, before the receivership happened, $100 billion was the expectation for what they were going to have withdrawn from the bank. I don't think I've never actually seen the number that they got withdrawn on March 10th, but that was the expectation, was that they had lots of money that they were expecting to be pulled out of that bank. And part of it was because when you have those, large uninsured deposits, you are uniquely vulnerable to withdrawals and to bank runs. And because they had all of these uninsured deposits and they had assets that were in 10-year treasuries, when people started pulling money out, they very, very quickly got into trouble. In literally 3 days. So now we have gone from, 9 months, 18 months, even 6 months with the technology now and being able to move money in a click. All of a sudden, like this can happen in 3 days, 4 days, 5 days. And I think to go back to, one of the questions that you asked very early on, that's part of why sometimes it's so hard to answer what is the metric to look at. How often do you look at it? Because of how quickly technology has changed, a lot of that is going to depend on your bank. Where are you having problems? Where are you seeing something? In the old days, you cleared a check, it took 2 weeks or 3 weeks, right? The guy literally at the bank had to look at it. Everybody's seeing the little green light, on the banker's desk. Like now you deposit it on your phone and most banks give you $500 of that right away. That used to be a courtesy, right? That used to be a marketing campaign. We'll give you access immediately. $300, $400, $500 of your check before it's cashed. And now that's just expected because it should be cleared by the next day.
Very interesting. A lot of questions are bouncing around in my mind. Coming back to the consumer perspective, do you know with the Silicon Valley Bank, were the uninsured depositors made whole, or were there any losses on that? Do you know?
That we could spend probably an entire week talking about bank failures. And while I don't know that the FDIC made everybody whole, and I don't remember the exact mechanics of how they did it, but they did end up making everybody, if not whole, nearly whole in a way that allowed eventually the funds that had remained in the bank to be recovered for the most part by those companies that had not gotten their funds withdrawn before the closure happened.
All right. Thank you. So banking's changed a lot. We talked about fintechs and technology impacts a little bit, but it's not just the banks that have risk, right? Will you speak to the Synapse scenario?
Absolutely. And I think that is not only a risk, but also an opportunity for banks when we talk about some of the fintech stuff, because, with Synapse, they were a fintech company, right? And they were a middleman basically between fintech apps that were banking apps and actual banks, right? So they have 4 banks. One of them is Evolve in Tennessee. I forget where the other 3 are, but basically what they did is they took, according to the bankruptcy filings, because Synapse has now filed for bankruptcy protection, they worked with about 100 fintech companies. And they said, according to the trustee, that they had about 10 million end users. So what they did is they took those fintech companies and the funds from those fintech companies, and they were the middleman with an FBO account at about 4 banks. So, we talk about the FDIC insurance is $250,000. And now you'll see a lot of those fintech companies offering up $1 million or $2 million of coverage, right? And so one of the ways that they do that is they use these FBO accounts and they, as I'm sure some of your banks know, maybe they don't, but, they spread that money out. So I give them $10, you give them $10, and they take $20 and they spread it out among 4 banks or 8 banks. And all of a sudden they get coverage from all of those banks, which means that you as a customer, quote unquote, have 4 or 8 times the FDIC limit. Now, the problem is whenever they do that right now, I send them money, you send them money. Well, Synapse as the middleman then sends the aggregate amount to the bank, to the FBO account. So the bank doesn't necessarily know who those funds belong to because they're in this aggregated FBO account. Synapse has that information because they're collecting it from the fintechs and they're sending it on. But what happened when fintech filed bankruptcy was, they're the middleman. They turned off some of the software that was really responsible for making sure that that money from the app, from the fintech app, went to the bank, and the bank then flowed back to that fintech app. And so when they turned off access, they basically froze everybody's account, right? So you might open your Yada account and see, oh, I've got $200,000, but you couldn't do anything with it because the software piece in the middle was no longer turned on. And you couldn't walk into Evolve because Evolve doesn't know that that's your money or that's your account. And they don't have a customer list the way a bank has to keep a customer list, or an amount list the way a bank has to keep an amount list. And so and they're going through the bankruptcy process now to try to work through all of that. And the banks have been giving back some of the money and working with all of those customers. But from May until about September, August or September, I forget exactly when they started the process of the refunds. If you had a bank account that was one of those fintech apps that use Synapse as that middleman, you basically didn't have access to your funds. Anything that was set up on an auto pay or anything that was set up that you were trying to use that account for didn't go through. But and it's really sad actually sometimes, because there was one story that I read. A couple had sold their home, had about $280,000 in profit, put it into one of these fintech apps because they always promote, that FDIC insurance and all of that, because as you said earlier, people really like that. That's important to people. And she had no idea how much she was going to get from the bankruptcy trustee. But they didn't expect to be able to get the $200,000 plus back out of their account. And they literally had sold their house. That was a lot of money. Like, it was everything they were going to use to buy a new house, and just frozen, gone.
It's a different banking experience. It's evolving very quickly. Bank boards need to evolve quickly to keep up on these opportunities that come with technology, which are awesome, but also challenges that come with technology and vendor due diligence as well. And of course, bank leadership. They've got to stay sharp and, as the saying goes, hostile, mobile, and agile. What are a couple of takeaways that you'd like our community bank listeners to be able to come back to and say, these 3 or 4 practices you need to do to help minimize the risk in your institution?
Absolutely. So I think the first thing is understand that the law is always going to lag innovation, right? So, for a bank, like, if you are looking for a legal solution, if you are looking for some type of solution outside of the bank, it may not be there, right? There weren't crypto regulations and then crypto was invented. Crypto was invented and then there were crypto regulations, right? So, from a banking perspective, understand that some of these advances, you're going to have to think outside of the box, because there might not be regulation for them. There might not be a standard or anything that you can look at, a process or a procedure to say, oh yeah, like, this is what the regulation says, so this is what we have to do. Or this is what the regulation says, so this is the, ratio that I need to run, right? Like, I understand that, sometimes you're going to be forward looking because there's no backstop on the backside from the law to help that. The other thing that I think, can be helpful for community banks as they embrace some of this technology is to use that to their advantage, right? So one of the things about Synapse being a fintech company is, there wasn't somebody that they could walk in and see when they had a question. There wasn't somebody that they could call and necessarily get on the phone all the time, right? So from a community bank perspective, you are in those communities. You are seeing those individuals. Like, you are able to tell them, look, not only, yes, there are these failures out here, and that's fine. Like, Synapse failed, like, these fintech apps, got impacted. That's not going to happen here, right? Because we have your account. We know exactly how much is in it. Like, this is how it works, kind of thing. And I think from that perspective, you really can kind of reassure your customers, reassure your clients, reassure your neighbors your parents, your grandparents, your cousins that are putting money into your bank, the little league team that has the money in the bank from their fundraising, like that you really aren't going anywhere. Like you're really just not. You are going to be there. You've been there for a long time. You're going to continue to be there. And then I think the third thing is, kind of what we talked about at the very beginning, which is just going back and taking a hard look at those ratios, right? Look at some of your numbers that maybe you haven't looked at your numbers from that perspective in a long time, right? And maybe it's a way to say, look, let's take a fresh look at what we're monitoring. Should we be monitoring something else? Should we be monitoring this in a different way? And then take a look at, looking at those processes and procedures. If you have time while you're opening the door and signing the checks and doing everything else, but taking that dedicated time to say, how do we need to change what we measure? And how is that going to change? Like maybe you're looking at something monthly, but now you're like, you know what, as this number starts to change, we want to look at it every couple of weeks or we want to look at it every day. Banking is getting faster, right? FedNow makes banking even more faster for those banks that have signed on, those institutions that have signed on. Like sometimes as that technology moves faster, you need to pay attention to it a little bit more often because of how fast it can impact your bank and your institution.
Those are a lot of good points there. I think it boils down to intentionality, staying fresh with things, looking at your data, looking at your processes, your people with the fresh perspective, making sure that you're not too busy, that you're appropriately staffed, you're appropriately trained, you're using the appropriate amount of technology to leverage time and some of the more mundane tasks so you can give the time and resources to understanding what the analytics mean and understanding your customer base and your institution. We agree with your second point exceedingly strongly that community banks have an advantage. We'd look at it a couple of ways. Number one, they're just closest to the customer. The customer can walk in and we can handle all of that stuff, the technology, but we also have somebody that we can see and we can get our issues resolved with right there. We have a saying internally at Midwestern Securities: in town, in person, involved. Again, it's just the same thing. We're close to the customer, and that's a competitive advantage. These things can be scary if you don't have the right team, if you don't have the right management, if you don't have the right leadership, the right vision, but they can also bring incredible opportunities for growth and differentiation in the marketplace, like you pointed out too. I think those are good. Angela, we need to start to wrap this up. I've really enjoyed our discussion. If our listeners, many of which are community bank leaders, presidents, CEOs, board members, leadership teams of all sorts, if they would like to reach out to you and learn more about you and your firm, what's the best way for them to do so?
The best way to do so is probably on our website. It's jacksonkelly.com. Jackson, Kelly, just like the names. And then there's a whole section on banking, and banking and finance. So you can find me on there. You can find, our team on there. And, if you have any questions or anything, feel free to reach out. We're always here, happy to help and support our community banks.
Thank you, Angela. So are there any last points you'd like to leave with our listeners?
I think the last point would be, don't be afraid, be excited. So you talk about some people come in and they're afraid, like, don't be afraid, be excited. Like, this gives you the opportunity to potentially change banking in a better way for your customers and for your community.
I like it. That's a great way to wrap this up. Thank you again, Angela, for being with us. And
thank you for having me.
Of course. I'd love to get a cup of coffee with you sometime in person and continue this conversation. But
sounds good.
For our listeners, thank you for joining. And on behalf of all of us at Midwestern Securities and Banking on Growth, until next time.
This has been another insightful journey with Banking on Growth with Michael Graham and Midwestern Securities, a member of FINRA and SIPC. We appreciate your time. If you found value in today's discussion, consider subscribing for more thought-provoking discussions in the world of finance. Your support helps us continue to bring you quality insights. If you have a topic you'd like us to consider covering or have thoughts on one of our episodes, we'd love to hear it. Just email us at media@midwesternsecurities.com. Remember, the power to grow is within you. Thank you for being a part of the Midwestern Securities community. Until next time, stay inspired and keep banking on growth.